Hello everyone and welcome to Market Week in Review for the week ending November 15th, 2024. My name is Bei-Chen Lin. I am an investment strategist here at Russell Investments. Today, the three things I want to talk about are the US inflation data, and a quick update on the Australian labor market, as well as talk about what it means when US large cap equities are hovering near all-time highs and how investors should think about the situation. So let's start by talking about the latest US inflation data. And this week we got two types of inflation data. We got both the consumer price index as well as the producer price index data. So the consumer price index data came in exactly in line with consensus expectations. Core CPI came in at 3.3% year over year, or 0.3% month over month. Now, it is important to note that even though core inflation CPI rates are lower than they were during the 2022-2023 timeframe, they're still not all the way down to 2% just yet. Meanwhile, on the producer price index side of things, those price pressures came in a little bit hotter than consensus expectations. In terms of the inflation measure that the Fed focuses on, that comes out towards the end of the month, and that measure is known as core PCE. Core PCE uses data that's available in both the CPI and PPI reports. So when we put those two CPI and PPI reports together, the implications for the Fed's preferred measure of core inflation would suggest that core inflation probably is still a little bit above the Fed's 2% target as of October. But once again, core inflation rates have come down quite substantially from their 2022-2023 peak. And as we look ahead into 2025, we think that core inflation will eventually get back to the Fed's 2% target. But these inflation reports that we got this month show that the path towards disinflation isn't always going to be a linear one. And there could still be some months where we have a little bit of a pause in that disinflation progress. All right, moving across the ocean to Australia. So this week we got a labor market report from Australia, and job creation did come in a little bit below consensus expectations. It came in at around 16,000. Consensus was looking for 25,000 jobs. But overall, the Australian labor market still looks relatively healthy. The unemployment rate stands at 4.1%. Yes, that's above the pandemic era low, but when you look at the overall historical context, that 4.1% number is still relatively low. We also got an update on Australian wage pressures this month, and what we saw was that wage pressures in the third quarter moderated compared to the second quarter and also came in somewhat softer than expected. So even though the Reserve Bank of Australia, the Australian Central Bank, hasn't begun its rate cutting process just yet, we think that these developments on the labor market front are encouraging in terms of suggesting that the RBA might be able to begin its rate cutting process in the near future, either towards the end of this year or early into 2025. Finally, I want to touch on what it means when US large cap equities are hovering near all-time highs. We saw that the S&P 500 once again broke through its all-time high record earlier this week. And I know that for some investors out there, when they see those type of headlines, they might be a little bit hesitant and they might be wondering, should I consider underweighting equities? And our answer is, we do not think that this is a time to underweight equities. Yes, it is true that on most equity valuation measures, US large cap equities look somewhat overbought. And yes, it is true that from a sentiment perspective, US equities, US large cap equities also look somewhat overbought. But the thing is, there is something called an equity risk premium. And the equity risk premium means that in the long run, investors generally get compensated for allocating to equities, for taking on the risk associated with investing in stocks. And so when we look at what's going on in the markets right now, even though we do see some headwinds for equities from here on in, we don't think that the markets have gotten to an unsustainable extreme just yet. And our philosophy is that unless we see markets at an unsustainable extreme, we don't think investors should make large tactical tilts. So instead, what we would say is we think investors might benefit from just rebalancing back to that strategic asset allocation to help preserve some of the gains in their equity portfolio. That's all the time we have this week. Thank you so much for tuning in, and we will see you next time here on Market Week in Review.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.